Hi everybody, I am Aditya Khemka from InCred Asset Management and I am going to talk about the markets today. The equity markets are at a juncture where multiple investors have given us a feedback that they are absolutely scared to invest in equity. And yet other investors tell us that they are really scared to jump off the ship because the ship just keeps sailing. I think this is a great time to talk about where the markets are in terms of valuations and how at the current time we should be investing in equities. In our perspective, and data suggests that the market is trading at 2 standard deviations above its 25-year average price to book valuation. The 25-year average price to book valuation for Nifty 50 is 2.8 times and the market's currently trade at 3.6 times, which is exactly 2 standard deviations above the average of the last 25 years. In these times, most of the available products across mutual funds, AIFs, PMSs would be 100% invested and would be largely owning stocks which have done phenomenally well over the last 3 to 5 years. Hence, we thought this was a great juncture to launch a product and market a product which would invest in stocks where there is temporary disruption or stocks which are under-owned and under-researched because there is lack of earnings momentum over the last 3 to 4 years. These kind of stocks would generally be going through temporary disruption or temporary earning depression, and earning depression can be a result of various factors. Some of the factors could be a dumping activity from China in the product field, or it could be a flood in the manufacturing facility, or it could be, something like a disruption in the marketplace with an online entity entering the marketplace. However, some of these disruptions don't tend to be structural in nature, they tend to be temporary in nature. What we have seen in the past 20 years of capital market history in India, that whether the market is at a high or at a low, there are always stocks and sectors which are under-owned, and there are always stocks and sectors which are going through some form of disruption or some form of disturbance in earnings and cash flows. And these essentially become great times to look at those stocks and cash flows. So what we essentially do in this product is, we analyze why the stocks or the sector has not done well over the last 2-3 years or 1 year, what has resulted in disruption of earnings or disruption of cash flows or margins, and whether the disruption is structural or temporary or transient in nature. If the disruption is temporary or transient in nature, we analyze and understand if the transition can happen to normalized earnings in the next year, 2 years, 3 years. If the answer to that is yes, then we do an analysis of what is our great price to buy that stock at and what is our margin of safety at that price. Once the complete analysis is done and we can get a risk-reward ratio of 3:1, which basically implies 3 times the upside for 1 time the downside, then these stocks become eligible to appear in our portfolios. Current baskets where we see such stocks and such opportunities include rural consumption, which has not seen any growth in the past 3 years because post-COVID rural economy just hasn't picked up. But we do expect rural economy to pick up in the next 6 to 12 months as more liquidity gets injected into the system. Another basket where we see this happening is healthcare. In healthcare, for the past 2 years, raw material costs from China had gone through the roof. And now that China is back to full-scale production, we expect raw material costs to cool off and the healthcare margins to improve. And next 2 years look really good for healthcare. The third basket where we see this happening is discretionary consumption. Again, because of the levered balance sheets of most of urban India and because of lower disposable income over the past 2-3 years, some of the discretionary items have not done well in the past 2-3 years. So we expect going forward inflation to stagnate and rather to cool off a little. And as income levels rise, the disposable income will again expand and that will help discretionary consumption across urban India as well. So that's the third bucket. The fourth bucket is IT and infotech. Basically, given by the rhetoric of the advanced economy recession, be it US or Europe, most of the IT companies have not done well because people expect order books to slow down. People expect earning growth to slow down, margins to compress. Although all that might happen over the next 6 to 12 months, we are pretty confident that the advanced economies have multiple levers at their hands to inject liquidity into the economy once inflation cools off and kickstart the economic growth again. And once that happens, you will see IT stocks, telecom stocks and infotech stocks start doing well. So that's the fourth bucket. And last but not the least, it's a capex revival bucket. There are certain companies that do capex which has a decision period of 4 years, 5 years, 10 years. And when these companies do this capex, the OPEX and the balance sheet hit and the P&L hit comes up front, but the revenue comes later. But once the revenue comes, most of the revenue flows down to the EBITDA and the PPT and the cash flow. So when you do the capex, balance sheet becomes heavier, P&L becomes lighter, so your ROE takes a double hit. The profits decline and the balance sheet size go up. And the opposite happens once the capex is monetized, because then the revenue comes, the balance sheet size shrinks because we repay the debt, and the P&L goes up because most of the revenue flows down to the PBT. So these are the 5 buckets, broadly speaking, where we see this kind of a mean reversion happening, and these stocks are available at, historic lows in terms of valuations, despite in a roaring bull market as you have seen right now. So, we are managing the product equity advantage fund exactly on these lines. We have about 35% cash in the portfolio. We have called only 30% of the committed capital. And, we'll be calling more capital as market gives us more opportunity to deploy capital. But, these stocks are available at very, very reasonable valuations. And once their earnings normalize and multiples normalize, these stocks can get phenomenal returns to their shareholders. So we thought we would talk about this product to you today. Have a good day. Happy investing. Can I ask you